Welcome to This Week in Impact, where we bring you some of the most interesting impact investing and sustainable finance stories of the week, as covered by Impact Alpha. I'm Brian Walsh. It's Thursday, October 31st. Happy Halloween to all who celebrate. I'm joined this week by Impact Alpha's editor, David Bank. We'll discuss this week's SOCAP conference in San Francisco, which had a focus on systemic change. Plus, how private investors are driving more money into blended finance transactions, and why global family offices are slowly warming up to climate investments. That's all coming up on This Week in Impact. Hi, David. Happy Halloween. I hope it's been fantastic for you.
Brian, thank you. Great to be back here.
Yeah, you've been traveling a bunch.
Well, there's people talking about doing the double, the Gin in Amsterdam last weekend, SOCAP in San Francisco this week, and there were a hearty few of us who have been jet lagged in both directions now.
All right, well, first up, let's talk about that SOCAP conference. This year, the theme was on systemic change. So what was the vibe this year?
Well, I think, and this was true also in Amsterdam at the Gin, there was a little bit more of a kind of prosaic feeling, I would say. And it may not be a bad thing. So folks, always gripe at these conferences sometimes that we've been having these conversations for a while. But I would say that the behind the scenes word that we were getting is that deals were being done, investments were being made. There's a sense that impact investing has been a little bit more resilient, and impact fundraising a little bit more resilient than the broader market as people sort of hunker down and get serious about the work. So maybe minds weren't being blown in the same way that they were in earlier years, but that might be a good thing as people are getting down to the work.
And maybe that also reflects the state of the impact investing ecosystem right now. It's gone from a buzzy startup with a lot of innovation, a lot of new concepts and new terms and new players, and now it's maybe maturing as an industry and as a field. So people come to kind of talk shop and get deals done.
Yeah, and there were some new things. For example, ownership and diversity, equity, and inclusion were grouped together for the first time. And I think that does make sense. We and Impact Alpha have been saying for a while that ownership, home ownership, employee ownership, ownership of financial assets is a path to bridging or narrowing the racial wealth divides. So that was an advance. The other thing that was sort of probably more prominent than in past years was AI, of course, here in San Francisco. It's kind of in the air, as they say, and I think folks have gotten over the kind of whether AI, which I think is a runaway freight train, and getting to more the how and the what, and there's lots of folks now putting AI to work for impact. AI equals accelerating impact was actually the name of the track at SOCAP. For example, training a GPT a generative pre-trained transformer, as they call it, to think like a social change advocate or dare I say, an agent of impact.
Well, that's interesting, David. Now, we're also just a few days before the 2024 U.S. elections, which take place next week. And right now we're in the kind of Schrodinger's cat realm of the election cycle. Both Trump and Kamala could be the winner next week. So how did people at SOCAP kind of react to this impending news?
It's striking because it was sort of implicit in a way, of course, but it wasn't very explicit. And so I think there were a few panels and discussions on investing in democracy, but there was not the sense of a kind of either full-scale mobilization on the one hand or full-scale crisis on the other. I found that interesting because I fear that folks may be underestimating the political risk that the country faces. And you talked about systemic, the notion that that political risk, is at some level a systemic risk that will affect all kinds of investment decisions. So leave aside all the other things that are at stake. stake in the election. Just what does it mean for investing, for impact investing, for the business climate, for the rule of law, which is sort of underpins the ability to make an investment and think about the future. And I sort of had a sense that maybe we were sort of in suspended animation, as you said, and we haven't quite looked down to see, for fear that maybe we're falling. So I found it to be sort of the, as they say, the dog that didn't bark in a way, was suspicious.
So are we the Wile E. Coyote who's run off the cliff but hasn't started following yet because he hasn't looked down?
I think that may be the case, and I guess we'll check back at next week's podcast and see how we've landed.
All right, we'll see if we'll have the results of Tuesday's elections by next Thursday's show. But for now, let's take a quick break. When we come back, how private investors, responding to aggressive efforts to de-risk deals and strengthen returns, drove a massive increase in blended climate finance transactions in emerging markets last year. All right, David, our Jessica Pothering reported this week on the latest State of Blended Finance report from the nonprofit Convergence. Now, as a reminder, blended finance involves layering grants and other forms of concessional capital and security mechanisms to reduce risks and strengthen returns for private investors. The approach generally involves quasi-public sector investors like development finance institutions and multilateral development banks. But something interesting caught our eye this year, an increase in capital flows from the private sector. So, David, tell us what we learned.
Well, blended finance, again, I think we've touched on that, has been, a great promise. As you said, blending different tranches together. Different investors can take on different risk profiles and different return expectations, and you can put those together to get deals done. And it hadn't really taken off in the way that people had thought. And then suddenly in the last couple of years, it actually has. And it's actually driven by bigger sized deals. And so, again, the increases are coming in bigger chunks and with more institutional capital. So it totaled up something like $18.3 billion in 2023, according to Convergence, which tracks this kind of things. And that's more than double over the previous year, which was itself up. So bigger deals. And what's interesting also is that the bigger deals get better leverage. So overall, you can say that each dollar of concessional capital has historically mobilized like $2.2 of private investment. And last year that was up to 2.65, so modestly up. But interestingly, for deals that were $250 million or more, it was more like $4 for every dollar. So the more bigger deals and more bigger leverage. And so it seems like the catalytic capital is starting to work.
You get the economies of scale when you're talking about these bigger deals. It kind of makes sense that you can get greater efficiencies by leveraging smaller amounts of catalytic capital to attract the larger sums of commercial capital.
So it means you can get capital to places where it otherwise wouldn't get to in just sort of a purely commercial context. So Gawa Capital out of Spain is layering first loss concessional debt underneath a planned $300 million fund to support rural livelihood climate resilience in Latin America. And then in Rwanda, a government-led vehicle is leveraging grants and again, concessional loans and credit guarantees and trying to mobilize $11 billion to meet Rwanda's climate plan. So, real money, real projects and things that wouldn't happen otherwise.
Now, you mentioned Rwanda, and one of the things that struck me from the report is that Africa represents the largest share of blended deals, with 41% taking place on the continent. So it's signifying the investors' efforts to move more money there.
Well, yeah, and that's not entirely, a coincidence, because the blending of the finance actually is being done by development folks, development financial institutions, and others who have a particular interest in reaching countries, low and moderate income countries, many of which are in Africa. So it's exactly those kind of emerging markets where blended finance has the biggest role to play because it de-risks investments that otherwise would be too risky for those commercial investors.
Any other examples from the report, David?
Well, Asia Development Bank is testing a blended finance model. They're calling it the energy transition mechanism, and essentially paying a coal plant not to operate.
All right, super interesting. You can read Jessica's full story on impactalpha.com. We'll also have a link in our show notes. For now, let's take one more quick break. When we come back, why global family offices are warming up to climate investment. Family offices, the investment arms for many of the world's wealthiest, are increasingly interested in climate investments, according to a new report from UBS. Lindley Browning reported for us this week that 44% of family offices see warming temperatures caused by man-made greenhouse gas emissions as a major concern within the next 5 years. David, what should we make of this new report?
Well, family offices, have been of keen interest in the impact investing world for many years, and the reason is that the principals are the families, and they're not. They can make their own decisions of what they want to do with their investments and how they want to take their returns, and if they want to take their returns in impact versus only financial returns, that's up to them, and they don't have to ask anybody else's permission. Again, that promise has not always been fulfilled, and I guess this report from UBS maybe gently suggests that the day is coming. The quote is that the inflection point of allocation is within sight, so it's not quite here. But there's some survey data that shows that family offices are warming up to the notion that climate's not only a major risk but also an investment opportunity. And so I think there's some thought that some of this $84 trillion that's passing to younger heirs by 2045 could actually, finance the green transition.
How do the intergenerational kind of dynamics play out here in these family offices?
Well, this is why banks like UBS and others, commission these studies, because what happens, generally speaking, is that the younger generation, being much more tuned in to sustainability and climate issues and other things, often changes their advisors and their wealth managers when the wealth changes hands, and so that has been a major driver for many of the big banks to get more expert in managing impact assets and talking to the younger generations. And so I think what's happening now is that the next gen has been kind of in the boardroom and in these discussions, but increasingly they're taking control, as their folks and grandparents die off, and that would change the calculation from sort of carve outs and trying out impact investing to try to move the whole portfolio. So I think again, the inflection point is not quite here, but there is the promise and the indications that there could be much more activity and much more ambition in family offices going forward.
One other point that I found interesting from the study is that over half, that's 55% of family offices globally, agree or strongly agree that difficulties in accurately measuring impact are holding them back from allocating more money to impact investments.
Well, Brian, I don't want to be the one to, argue against, better data and better measurement. And I certainly don't, and I certainly applaud the impulse of these family offices to protect against greenwashing. But I must say that sounds like the kind of excuse folks offer when they don't want to do something. So I think there's plenty of data and plenty of ability to measure. And I think what they need to do is turn those intentions into actions right now.
All right. Well, we'll leave it there. You can read Lindley's article on the UBS report on family offices on impactalpha.com. There's a link in our show notes as well. But for now, that's going to do it for This Week in Impact. Thank you, David.
Thank you, Brian. It's a pleasure as always.
As always, and thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha Podcast Network. Smart conversations by and for impact investing professionals. For more exclusive stories about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. If you like the show, please subscribe to the podcast wherever you listen and be sure to leave us a 5-star rating. It really helps other people discover the show. Thanks, as always, to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh, and we'll see you next week for more Impact.